That's two sharp down days on the S&P 500 and the broad market as a whole this week so far. So in today's video, we're going to talk about where do we go from here. Have the tides changed? I'm going to break down the technicals to answer that question. And we're going to look at a stock that may be at that inflection point because of this pullback and see how we can trade that for today's trade idea. So let's go ahead and get started. Today is Wednesday, June the 27th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, thanks for tuning in, especially those watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Mouse over the Market Scholars logo in the bottom right corner of your video. Click the red subscribe button that pops out there. Also, click the thumbs up icon that's down below the video. That lets me know two things. Number one, you like the video, you got something out of it. Number two, you want us to keep doing these videos day after day. Comment on anything that stands out to you. What did you pick up? What did you learn? What questions do you have? Comment down below. Join our Market Outlook email list, our daily email list. There's a link popping out in the top right corner of your screen. Click on that link and subscribe. Follow on Twitter for more content like this throughout the day, and join our Market Outlook community on Facebook. All right, well, let's take a look at the S&P 500 here. First off with the market forecast indicator as always, and you can see we talked yesterday about, maybe in the next day or two we would fill in, trade inside this range here, and potentially even fill in the bottom of that candle. Well, that happened today, just like that, in just one day. We started to bounce up higher. Started the day pretty well, and then it was a late sell-off. We'll take a look at it more here in just a minute. But from a market forecast standpoint, you can see the red line. We have a red line now, and we're pink. That's the combination. You get the red lines when you're pink. Red lines when you're pink here. That's, we are done. The intermediate run is done on the S&P. It's done. It was already done on the Dow Jones Industrial Average, also trading within the range on Monday. The NASDAQ, actually, because it was a tech sector, as you can see over here, kind of leading the way down, the NASDAQ actually fell, still only getting to the 38% Fibonacci retracement, though, of the intermediate run. So just remember, the bigger declines come after the bigger rallies, and not a lot of people were too complaining about how strong this intermediate rally was. Like, again, this is the intermediate run since the intermediate line crossed up above 50. During that intermediate run, from the low point there up to the high point up here, at least to the close, you look at those numbers across the top, it's a 12% gain in 56 days. 12% gain in 56 days. It's an 80% annualized return. Needless to say, pretty good day. Pretty good move, and now we are feeling the effects of that pretty darn good move right now with the pullback to what is now this 38%, 7,500-ish, 38% Fibonacci retracement. You can see the near-term line, the momentum line fell to all these extreme lows on all the indexes. You can see the Russell is, again, it was even a bigger move. So its intermediate rally, if I were to draw the same line from beginning to end up here, it was a 15% gain in 79 days, 57 trading days. You can see 15%, 15 and a third. That's a 70% annualized return. So again, bigger pullback, and that resulted in multiple clusters, right? Multiple overbought clusters, in fact, 4 in a row. And now, its intermediate run has not ended yet. It's still pink, or light pink, excuse me. But again, considering the Dow and now the S&P have, and the NASDAQ's probably another day away. You would expect that it would. There's your last intermediate peak right there, which happens to be right around the 50-60% Fibonacci retracement. Most likely we're gonna get a dark shaded pink here too, and then potentially start a new intermediate run. The question is where, and the near-term pullbacks, last a day or two, maybe 3. The intermediate pullbacks, for a lot of people now, feel like the world's going to end because 2017 has conditioned us to not have intermediate pullbacks, just to have short, like this kind of move for a whole year, and that's just not the reality. And this is the move, right? This is where, and this is a market sentiment pullback. that kind of felt like a bear market for that matter. So this, as of right now, intermediate lines falling. You have market sentiment falling too, albeit at very high levels. It's rising on the NASDAQ still, rising on the Dow still, and rising on the S&P still. So you still have rising long-term moving averages. Obviously, if we were to get really bearish and get through these Fibonacci retracement zones on all these major indexes, then we're probably going to have a much more bearish posture. This will have basically a phantom red arrow on the market sentiment on the orange line, and will be a lot more bearish. But even then, consider, here's that market. This is the Fibonacci retracement levels of the long-term run. This is the previous long-term run that ended here, and here's the beginnings of the new long-term run. Obviously we haven't got to higher highs on the S&P like we did the other, like the NASDAQ and the Russell especially. But you can see here that we came down to the 38% Fibonacci retracement of the last long-term run during that pullback, and now we're rising. So, again, we expected multiple intermediate runs, and when you expect multiple intermediate runs, they've got to stop, right, and start again to get another one. So we're stopping here, and we also talked about the expectation of getting shorter and more frequent intermediate runs than we did in 2017, simply because of the maturity of the bull market that we're in right now. So right now we look at this as a intermediate pullback and see if these Fibonacci retracement zones hold, and if we were bounce back up off of these and start new intermediate runs. That would be the expectation. Of course, doesn't necessarily mean it has to happen, but that would be our expectation here going forward. In fact, one of the things I tweeted out yesterday from Ryan Dietrich was, we had 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row where we rallied on the Russell 2000. Doesn't happen very often. In the last 9, in fact, it's happened 9 times since 1950, I believe. Well, let's see what the tweet said. Here we are. So apparently, it must have deleted the tweet that I shared with you. But you can see here's all the other times that the Russell 2000s had 8 weeks in a row, and they gained over the next 6 months. You can see during the strong bull market there, and even some of these other years, still always positive after all is said and done. So, the other thing we have talked about as well, heading into the end of the June, was the seasonality of the S&P 500. If I were to clear off all of these and bring back up the seasonality chart here, there we go, and then we'll look at price as a percentage. Whoops. Hit. 1 second. There we are. So there's the weakness heading into the end of June that we typically get. We're getting that right now, and we come out of this usually until on average until July expiration. So we get a run up to new highs. Whether we'll get a run up to new highs or not remains to be seen, but we are playing into a typical seasonal weak period heading into the end of the quarter. We typically rally out of this, and as of right now, that's kind of what we look for, is to rally off of what could be a new intermediate low point that would be higher than the last one, as long as these Fibonacci support levels hold. All right, before we look at the other charts, I did want to remind you we only have a few more days left, 3 more days, until our last day that you can sign up for our premium service with that discounted offer. Right below the video that you're watching, there's a link that will give you information, more information on that. There's the link there, and there's the page, and of course as you scroll down to the bottom is the sign up page. There's some sample classes down here at the bottom, a Q&A session. You can also see that a new feature here that we allow you now to pay in installments, pay over 6 months for that discounted offer. I also got a lot of questions too about the classes we offer. This is our calendar. I wanted to show you what our calendar looks like. All of our classes, this is for June. You can see they're all recorded. Anyone who signs up has access to all of these going back to March when we started our soft launch. Over 200 hours of content here posted on the calendar, but you can kind of get an idea of how often we teach classes. You know, we're a little light this week because I'm working on the launch for next week. But these are the, you know, we have classes for buying stocks like top-down trend trading and dividend growth investing, as well as strategy lab. We have classes for buying or trading options, a basic class, options for long-term investors, an intermediate class, directional option strategies, and a more advanced class, options inventory trading. And for those who are looking to build a portfolio, we have ETFs, a class on ETFs and building a portfolio with ETFs, and 2 Q&A sessions at the end of each week. And that's our typical calendar. And as we mentioned before too, we are starting a new class next week, a new live market outlook video where we'll start managing. We'll start managing all the trade ideas from previous market outlook videos live. During the session will also be recorded. You'll be able to find it there too on the calendar if you weren't able to catch it live. But you'll also see the trade idea that we always post in the Market Outlook videos in the evenings. When you're watching this on YouTube, you'll be able to see the trade idea before the market closes live. You know, they're at 3:30 Eastern time. So that will be a new class again for Market Scholar subscribers that will be starting next week. It'll be also on this calendar too. All right, we'll take a look back on the charts, and you can see on our long-term chart here, we're still below a 50-day moving average. We've done this before. We're doing this again, and you can see we pulled down to the 200 before, bounced and rallied. We'll see if we end up doing something similar, or if we bounce right now. You know, back here, after touching the 200-day moving average, we bounced and rallied and came down a little bit before bouncing multiple times. And we've always talked about how right now we're in a similar period to where we are here, where we're going to grind towards zero on the MACD with that 50 and 200-day moving averages. Let's take a look at the 3 green arrow chart for the S&P 500. So we're shaded pink on the market forecast. We're still green on the long-term chart, but we're pink here too with 3 red arrows on the MACD, stochastics, and moving average. And then you can see too how now the 8 and the 17-day are pretty much dropping below that moving average. So below the 30-day moving average, and the MACD is negative. The stochastics is in that oversold reversal zone too. So all those are pointed lower. Again, you know, this is the near-term retracement level. The Fibonacci retracement's down here. So, you know, if these Fibonacci retracement zones hold, we expect a new intermediate low point to come out of this. And if they don't, then obviously we get down into this area. And now you'll have much stronger support level in here in 2600. But the market sentiment rally will most likely be over, you know, at that point. Okay, now we'll take a look at the intraday chart here for the S&P. So the short term, so long term is still green. We still got the bullish, you know, the 50 is above the 200. Some, you know, it's kind of light green since we're below the 50-day moving average. The price is currently in between. But then you have pink on the market forecast, pink on the 3 green arrows, so those are your intermediate terms. And now we're bearish here. We didn't produce a new 4-week low point, but we came pretty darn close, closing right at the lows of the day with a lot of selling volume here at the end of the day. So far in the after hours, we're up. You know, we're up to where we at here? 260. We're up about 40 cents. So just a smidgen, not a whole lot in the after hours, but that puts us up closer into this area. But still, you can see how low that is and how much we fell today. That's a pretty large trading range. In fact, you can see here, if I were to go back and see the ATR, see how we've doubled. The ATR was double the average on SPX and SPY. You can see the same thing. So very, very large trading range here with a lot of volume. So go back to the volume here just so you can see that. Back up to that, you know, high, you know, 105,000, 105 million shares trading hands. So let's see this chart here. So 4.69's here, 100 some odd millions right here. Those are pretty, I mean, that's not extreme. So those are bearish. but not extreme. And you can see the ATR on a relative basis is starting to increase and potentially getting back up above 1%. That would be bearish. Bullish below 1%, bearish up above 1%. So you can see how we're starting to rise and make our way up into that direction. And finally, the last thing we look at is the VIX. The VIX itself is still relatively high, near 18. We even talked about that yesterday, that we would expect it to come on the near-term weakness, come up and form a lower high point off of a higher low, but form a lower high point, and that's still the possibility there. And then, of course, you can see the same lower high would also form here. We're in the bearish zone, but not too extreme. We didn't even get up to 1 today. So that again kind of shows, as bearish as we are today, we're as bearish on price as we were before, but you can see volatility is not priced as high. So the market's not as scared about the sell-off now as we were before. So we'll see if we end up forming a lower high point. Again, we would expect that to happen if we're going to bounce off these intermediate support levels. All right, so what do you think? There's a poll popping out here in the top right corner. Do you agree with that posture? The fact that we are in this intermediate pullback right now to what still could be obviously a higher intermediate low point if these Fibonacci areas hold, or are you more bearish than that? Let me know what you're thinking there. Comment down below, especially if you are more bearish than that, and share what you're seeing there that we haven't brought up yet. All right, now let's transition into what's driving the price action today. And you can see energy continues to just really dominate. Crude oil rising for the third time in the past 4 trading sessions, now up almost 9% over the past couple of weeks. Emerging market, and the dollar's continuing to rise too. So again, don't see that. You don't typically see a safe haven move where bonds and the dollar rally and crude oil rallies as sharply as it's rallying too. Putting pressure on equities, but especially emerging markets because of the strong dollar. You can see gold continuing down 4% there. There's the biggest movers today. You can see visually emerging markets, small caps down the most. There's developed markets and large cap stocks. Agricultural commodities falling, gold as well, foreign bonds and high yield getting hit to a lesser extent. Preferred stocks kind of holding flat and steady on a down day. So you can kind of get an idea of what's going on here from a broad perspective, a risk-off move, but with that strength in crude oil coming from petroleum status report. A couple of interesting things coming out. The trade data came out to a much smaller than even what the estimates, the lower end of the range of the estimates. So a strong move in exports. You also had a little bit of weakness in durable goods, but the year-over-year rate still very strong. And so as a result, you see GDP estimates are still holding up too, pulling back a little bit down to 4.5%, but still holding up very well, higher than where they originally came out at, and obviously higher than the consensus that continues to rally and move higher. Economic indicators aren't really beating estimates anymore, so we're about as flat as you can be. Over the last 3 months, we've pretty much been hitting estimates according to this indicator. And usually when you're beating estimates, indicators are improving, and when you're not beating estimates, indicators are not improving. Right now we're kind of in the middle, but things are starting to improve a little bit on the global front. So we'll see if that's been a pressure before. If you take a look at the foreign markets here and how they've done, Russia was the biggest. All the major economies were down today. Russia being the Russia being the smallest, or having the smallest loss. If you were to take a look at the foreign markets, this one, still getting used to these. But you can see the foreign markets, the S&P 500 is right here, and it fell throughout the day. But you can also see, another oversold cluster in United Kingdom. This is France, another oversold cluster there, another oversold cluster in Italy. We almost got one yesterday, but now we're getting an oversold cluster in Germany. We're getting an oversold cluster here in Korea, even though Korea beat Germany today in the World Cup. Getting an oversold cluster there. You can see the drop in in India, and the drop in China getting another oversold cluster. So these trade battles are impacting everybody. There's Canada, very similar move in Canada to what we saw here, a very similar candlestick pattern developing too, as well as in the UK. Brazil, falling. So emerging markets getting hit the most. There's the emerging markets: Brazil, China, and India. Only Russia was the only emerging market in this list, and Korea to a small extent. Russia is the only one that didn't fall as much. And you can see Europe. You have United Kingdom. You have France, Italy, and Germany all kind of matching the U.S. drops. And you can see Canada also kind of matching there, and Japan with a small gain. But still, oversold clusters across the board. Equities as an asset class are really struggling right now, and going back even further to a 3-month time frame on this. They've, at least not so much abroad, but at least here in the U.S., the U.S. has been a big beneficiary of the sell-off in global equities. They've moved to U.S. stocks, and now U.S. stocks are starting to pull back. And your biggest winner over the past 3 months is crude oil, back up to its 3-month high point at 12%. You also have the dollar up past its 3-month high point to a new 3-month high, up over 7%. It's a strong move for a currency. Then you have your equity asset classes. Now treasuries are outpacing high yield on a 3-month basis. Just barely, but now outpacing high yield. That's another sign, a little bit of a rotation into risk-off move from a broad equity standpoint. But again, intermediate pullbacks. These are intermediate pullbacks. These are the type of patterns. You might not get these types of patterns in a 1-day pullback or a 2-day pullback. And I know that that's kind of what we're accustomed to. But during intermediate pullbacks, where you get a 15% or 13, in this case, a 13% rally. Here you can see a little bit better here on the 6-month chart. When you get such a strong move higher on, here, let's zoom in from this low all the way up to that high point. Almost 15% gain in IWM. When you get that kind of move, you're going to get some pullbacks. Now, not everything participated, but and S&P participated to half the extent. But still, when you get that kind of a move in a small period of time, you're going to get some pullbacks here. And that's, as of right now, that's what we're getting. Now, it can obviously anything can happen. It can turn into something more bearish than that. But from a economic, and a lot of this is driven by headline news, but from an economic standpoint, economic indicators might not be beating estimates, but the biggest one is still showing some very good, strong growth potential for the second quarter. And now earnings is upon us at the beginning of July, and that can also have an impact on the earnings growth in the S&P 500. Will also have an impact to see whether or not and how fast we bounce off of any new intermediate low point that we could form right now. From a sector standpoint, you can see the sectors that did well today. These are the only two that rallied, but you see the sectors that are outperforming all have bullish intermediate postures. In fact, all their intermediate lines are all up above 80, above 90. So very strong and rising trends. So not everything is down. In fact, 8 of the 11 sectors all beat the S&P today. The things that struggled the most are the things that had rallied the most. And you can see technology is just now turning bearish. Now its intermediate line's falling below 50 finally, but you can see how the red line, the moving average has barely turned red. The discretionary hasn't turned red yet. It's just pulled down to the moving average. It actually turned yellow here. Financials is the one that's struggling the most. Finally getting an oversold cluster here, and see if we end up coming off of that like we have Staples when it came off of its oversold cluster, and telecom as well. So, and here's your tariff sectors. Industrials at a low point, down 3% for the 3-month period. Materials also close to a low point. So if those hold, and financials down 3% too. So those are your worst performers over the past 3 months, financials and industrials, and they've been hit the most by the headlines, right? Tariffs and the flattening yield curve. And they're both showing oversold signals. The intermediate line is below 10 on the industrial average, below or close to 14 on materials. You can see healthcare's got a falling, but it's just barely above. It's still above 50. Discretionary is falling, but it's above 50. So we have, I mean, not everything is doom and gloom here, and we have some areas that have been doing really well. And these are the areas that we happen to be focused on in the last so many market outlook videos with our trades, in particular the stock trades in the staples area and the utilities area. One of those stocks that kind of fits both the bills of technology and consumer discretionary is Activision Blizzard, a gaming company. Has a very common pattern, similar pattern to what you see on a lot of stocks right now. A lot of them getting 3 red arrows. Now, typically when you see 3 green arrows like this is if you own the stock, which in this case has been a bullish intermediate trend. This would be the time to move up a stop order. The expectation is that we'd bounce off of this, and if we don't, you're stopped out of the trade and you move on over your previous trend trade. So what we're going to do is we're going to trade with the anticipation that we bounce. But we're going to do it a little bit differently. Normally you'd say, okay, if this is a speculative trade, then we'll look to buy a call option here. And typically we go 2 to 1 profit loss ratios, considering the lower probability nature of buying a call option. And we're going to do a little something different here. We're going to sell a put at the money. The highest extrinsic value right now is the 72.5. So we'll sell the 72.5 and buy the 70. That's a typical bull put spread of what you're normally accustomed to. But you notice with the $2.50 wide spread, we're getting much higher credit than what you would anticipate. Now, of course, we have earnings coming up, something we do need to keep in mind going forward with this. And we're going to see what happens with this trade before we get to that earnings, which is 8/2, so a couple weeks before expiration date. All right, so that being said, and of course we'll account for this with a smaller position size than what we normally do. Normally we kind of keep it smaller anyway because of the speculative nature, but we're going to account for that extra risk with a smaller position size. If this trade blows up and hits max loss, then that's okay because we'll take a smaller loss than what we normally do if I was doing a regular bull put spread without that extra risk, event risk there. So I've got the short put at the money and buying the long put, and with a credit that's far more than what we normally shoot for when we're going for that 30% return on risk. Now you notice when I look at this on a here on the Analyze tab, you can see going into August expiration. Here, let's reset parameters. You can see I got a slightly better than 50% chance of success on this trade. There's my break-even point. You can see the maximum gain on this is 94 bucks, what I'm trying to get. And typically when we go for a profit-loss ratio, we're going for that 2 to 1, which means I'd be willing to lose 47 bucks on this trade. And you might think, well, that's not a whole lot, right? We can lose $47 really easy. Well, keep in mind right now, there's my delta. So if we go down $1, I'll lose it 10 bucks. And if we continue to go down, you can see what happens to the delta. It starts to rise up a little bit. You got that negative gamma going on right now. Eventually that gamma will turn positive. But you can kind of get an idea. If we go down a few bucks, that's what it will take. In fact, according to the purple line, to get to that $47 loss, we have to go down today down to 70 bucks. So that would be a move down into that area. And you can see with time decay kind of where it's at, even by the end of next week, that's about the same. It's got to go down to about 69.5. So, we're talking like a move down into here for us to, and getting below that particular low point, which would be a lower low point, we'd have to break down there to get a loss that is half of what we're trying to make. So and that would be an exit to get out of the trade and move on to something else. And there is my 2 to 1. Now, of course, we position size for worst case scenario. So that's also how we'll be a little bit more conservative on this. So position size smaller than normal because of the event risk. And we'll also position size the maximum loss, knowing that we will take far less than 156. We'll target a $47 loss, which is half of what we're trying to make. So there's my 2 to 1 profit to loss ratio, but we're going to account for the extra risk with a smaller position size and a bigger trade risk than what we will plan on taking if this thing does go against us. And if it bounces up, then great. We'll take we'll take that $94 gain for that $47 loss that we're willing to accept on this trade, the 2-to-1 profit to loss ratio. So it's a bull put spread like what we've been doing. It gives me a similar profit to loss ratio as a long call would, and is a way to be a little bit more conservative with reducing my risk and having a bigger trade risk, with the maximum loss there. And if it does blow up, then we will take that full portfolio risk, and that's okay because that's what we position size around. Otherwise, we'll take a really small loss and then shoot for that, like I said, 2-to-1 profit loss ratio. All right, so now I'd love to hear what you think. So there's a link popping out in the top right corner of your screen. Click on that link. That takes you to our Market Outlook forums on marketscholars.com. I'd love to hear your thoughts on tonight's Market Outlook. I'd love to hear your thoughts on tonight's trade idea. Let's chat. Do you have any questions for me? Do you have any comments? Post them there, as well as it is a forum, so we can all interact and anybody can answer any questions or comments. It's a great way for there to be some interaction there. As always, thank you very much for watching our video tonight. We'll be back on tomorrow. Brandon will be back on tomorrow and then Friday to close out the week. So be sure to stay tuned. Again, remember to subscribe to our YouTube channel, like the video, and comment down below. Follow us on Twitter for more content like this, and join our Market Outlook community on Facebook. Have a great evening, everybody. We'll see you all next time.